Okay, let's just dive right in with a pretty bold statement, right? Why your 1 crore flat could be a bad investment. Now, I know what you're thinking. For so many of us, buying a home isn't just a transaction, it's like the ultimate life goal. But what if the numbers, the cold hard facts, tell a completely different story? Let's break down why that dream home might not be the dream investment you've been sold on. This really is the big question we're tackling. I'm sure you've had this exact debate with family, with friends. Is property still that unshakable foundation of wealth it used to be? Or has the game just completely changed? And for a very good reason. Owning a home it's woven into the very fabric of our culture. It means stability, it means security, a legacy for your kids. It's real. You can touch it, you can see it, you can live in it. And that feels solid in a way that, let's be honest, stocks and bonds sometimes just don't. And if you just look at the headlines, that dream looks more alive than ever. We're constantly hearing about a booming market. You've got cities like Mumbai now playing in the big leagues, ranking in the top 10 on global luxury property lists. I mean, everything seems to be pointing in one direction. Real estate is a sure bet. And then you hear this exact sentiment from the absolute titans of the industry. You have real estate billionaire Dr. Nirjan Janhanandani saying it's not just an investment, it's a fundamental need. I mean, this is the powerful traditional wisdom we've all grown up with. But is it the whole story? So let's move from the dream to the reality. Let's talk about the actual price of a home, because when you start peeling back the layers of this thing, you find out the true cost is a whole lot more than just the number on the brochure. Okay, so let's start with the sticker shock, shall we? In the Mumbai metropolitan region, you're looking at an average price of 17,600 rupees per square foot. What does that mean? Well, it means a pretty standard 1,000 square foot flat, which is not a palace, by the way, can easily cost you over 1.7 crore rupees. That is a massive, massive amount of money for most of us. Now, here's where it gets really interesting. You've just invested crores into this beautiful asset, but what does it actually earn you in income? Typically, you're looking at a rental yield of just 2 to 3% per year. To put that in perspective, a simple fixed deposit in a bank often pays you more than that. So when you look at it as a pure income-generating asset, the math starts to look, well, a little weak. And the costs just keep on coming. It's not just the purchase price. You've got stamp duty, registration fees, GST. You add all of that up, and bam, it can wipe out up to 11% of your property's value in the very first year. Just think about that. Your property needs to jump in value by more than 11% just for you to break even. And on top of all that, if you ever need cash in a hurry, good luck. You can't just sell a flat overnight. It's what we call a highly illiquid asset. And beyond the numbers, there's another risk: fraud. As business strategist Sonu Sharma points out, yeah, every field has its bad apples, but in real estate, the damage can be catastrophic. We're talking about someone's entire life savings down the drain. It's a really sobering reminder that you have to be so careful. So, if buying a single flat is this complicated and this expensive, does that mean you should just avoid real estate altogether? Well, not necessarily. Let's talk about a totally different way to get into this market. Just think about this for a second. What if you could get a piece of that booming real estate market? We're talking premium office parks, fancy malls, without needing crores of rupees and without any of the headaches of being a landlord. Sounds pretty good, right? And make no mistake, the smart money is pouring into Indian real estate. We saw a record capital inflow of $5.1 billion in just the first quarter of 2024. That shows you there's huge institutional confidence in this sector. So the question is, how are all these big investors getting a piece of the action? And that brings us to the main alternative we're talking about today, REITs. Now, that's a term you might have heard floating around, but let's actually break down what it is and how it works for you as an investor. So, a REIT, which stands for Real Estate Investment Trust, is basically a company that owns a big portfolio of properties that make money. Think huge office buildings, shopping malls, warehouses. And you can buy shares in this company on the stock market, just like you'd buy shares of any other big company. It's a way to own a tiny piece of many, many large properties all at once. Okay, so how have they actually done? Let's look at the report card. The numbers for India's listed REITs are pretty compelling. Take a look at Mindspace Business Parks REIT, up a massive 57% since it listed. Embassy Office Parks REIT has also seen fantastic growth at 41%. This isn't just a nice idea, this is proven market performance. And you can really see the impact right here on this chart. Mindspace is leading the pack with that 57% growth. And remember, this performance isn't just from rental income. It's driven by the increase in value, the capital appreciation of all those high-end commercial properties in their portfolio. And that's growth that you, as an investor, get to share in. So let's just quickly sum up the advantages here. You don't need crores. You could start with just a few thousand rupees. You can buy and sell your shares literally any time the stock market is open. That's what we call high liquidity. You're instantly diversified across tons of premium properties, not just one flat. And the whole thing is professionally managed and regulated, which gives you a level of transparency you might not get in a private property deal. So after all this, what's the bottom line? Well, it's not about finding one single right or wrong answer. It's really about you understanding clearly what it is you're buying, and maybe more importantly, why you're buying it. Let's just put them head to head one last time. Buying a flat, huge capital, very low liquidity. You have to manage it yourself, and all your risk is tied up in one singular asset. REITs, they're the complete opposite on every single one of those points. Low capital, high liquidity, professional management, and you get instant diversification. The contrast is pretty stark. And this right here, this is the key takeaway of this entire discussion. Buying a home to live in is an emotional choice. It gives you shelter, stability, priceless memories. You can't put a price on that. But if you are buying property purely as a financial asset, something to grow your wealth, then it has to be judged by the cold, hard numbers, your returns, your liquidity, and your risk. You have to separate those two goals. So if you are still set on buying a physical property, that's totally okay. But please do these 3 things first. 1, do your homework on the developer. Use the RERA portal to check them out. 2, run the numbers honestly. Calculate all the real costs and the realistic returns. And 3, be brutally honest with yourself about your goal. Is this a home for my family, or is this a piece of my financial machine? And that's the question I want to leave you with. Now that you've seen the data, you've seen the alternatives, you can think about this more strategically. Is your next real estate move going to be for your home or for your portfolio? Because knowing the difference, that's everything. The choice, as always, is yours.